Hello and welcome everybody. Happy Friday, welcome to the end of another week and another Sectors Made Simple webinar. Today, we're going to be doing something a little different. Back in our Back to Basics series, we covered relative strength and how we use it here at Sectors Made Simple. But I got a couple of emails from you all that wanted to see how we can use relative strength in more ways than just how we use it for sectors. So today we're going to cover 5 different ways that we can use relative strength. Some are going to be very simple. Others are going to look a little bit more in detail at sector ETFs, index ETFs, and more. So, not going to give too much away in the introduction. Instead, I say let's get straight into the action with today's webinar. So, hopefully you all enjoy, because today we're going to be talking about 5 ways that we can use relative strength to help our investments. So the goal for today is pretty straightforward. Relative strength is at the center of most of the tools that we offer here at Sectors Made Simple. After all, it's called the Relative Strength Matrix. That name has to come from somewhere, right? So it's no surprise that we use relative strength quite a bit, but it can do a lot more for us than just creating the matrix. For the matrix, we compare one sector ETF to another, and then compare that sector ETF to another, and so on and so forth, until we've done that 132 times per day. But that's a lot of work, and that's why we do the matrix, is so that you don't have to. But instead, today I want to cover 5 ways that we can use relative strength to help our investing, that you can do at home and is reasonable but also actionable. The point of this information is you can use this to help your investments. It can help you make decisions, it can help you grade an ETF, and so much more. 4 of these ways are for everyone. You don't need a Sectors Made Simple subscription to utilize this information. The 5th will require an SMS subscription, but we'll get to that when we come to it. Before we get into what these 5 methods are, the first thing we need to do is cover what relative strength is. So let's do just a really quick review on what relative strength is. So if you haven't watched that Back to Basics episode, you can still understand what we're talking about today and use these 5 methods with the information from only this webinar. So relative strength can be done with any type of stock chart, but because we talk a lot about point and figure in all of our webinars, and also point and figure is very useful for 2 reasons I'll mention in a minute, we're going to stick to using point and figure for all of these examples. Point and figure, or relative strength in general, allows us to compare the price of 2 things: stocks to ETFs, ETFs to stocks, ETFs to indexes, almost anything. And a lot of this is available to us for free on stockcharts.com, and we'll be using stock charts quite a bit for today's webinar. These charts do not show price. There is no relative strength thing that you can purchase. Instead, what it does is it shows us the ratio between the 2 different securities. And just like any good chart does, it will show us the changes in this ratio over time, so that we get to know, is the thing we're looking at gaining strength or losing strength compared to what we're comparing it to? So that's what relative strength is, but how do we actually find it? How do we go from the price of the healthcare sector ETF, XLV, to XLV compared to the S&P 500 ETF, SPY? So let's just do a quick example of actually creating relative strength. The first thing we need is what we are looking at. In this case, we're going to use the S&P 500 ETF for technology, XLK. Then to tell stock charts that we want to do a relative strength, we're going to put a colon, so the dot dot, and then what we want to compare it to. So in this case, we are looking at XLK compared to XLB, the materials sector ETF for the S&P 500. So whenever we're looking at this, what we'll end up seeing is if XLK is stronger than XLB, if it's gaining strength, we'll see the chart going up. After all, it is what we are looking at compared to what we are comparing it to. So when the thing we're looking at is growing faster than what we're comparing it to, the chart's going to go up. The value is going to go up. Just like if what we're looking at is losing strength, be it the price is going down or the price isn't rising as much as what we're comparing it to, then the chart will go down. Something important for us to remember. Relative strength is just that, relative. Just because the chart's going up does not mean that those securities are making money. It doesn't mean that they are giving positive return. All it means is that the thing on the left is gaining strength compared to the thing on the right. If it's going down, that does not mean that the two securities are losing money. All it means is that the thing on the left is not doing as well as the thing on the right. We could have both securities that are losing money or returning negative returns. And because the thing on the left, didn't lose as much as the thing on the right, the chart would be going up. That's why when we're doing relative strength, it's important that we do something else as well. And the 5 methods we'll cover today are supposed to do just that. It's supposed to look at something that's not just relative strength, and instead use relative strength to give more information to what we're already doing. So let's really quickly do an example using the chart down here, or I guess over there, to look and see how we would turn prices into a relative strength chart for relative strength. My apologies. Again, what we see on this chart, those values are not a stock price. There is no thing XLK, XLB that you can go into Fidelity and buy. It is not $166.87. That again is the ratio between those two securities. So the exact way that we find the relative strength value is we take the price of the first thing and we divide it by the price of the second, multiply it by 100. So again, let's take this example, technology compared to materials. We'll just bring technology down here. And the first thing, the numerator, or the price of the first security, is going to be XLK's price. That dot dot we can turn into the divided by, and then XLB becomes the denominator, or the second security. Then, once we've done the math, we multiply it by 100, and that will give us the end price of that relative strength. Once we have that number, the rest is simple. We can find where it was earlier today and yesterday and the day before and the day before, and put those onto a chart. Again, it does not need to be point and figure. We can do this for any kind of chart. We can do it with a sharp chart. We can also, of course, do it with point and figure. So we see that here. Do note, Point and figure is the one that multiplies it by 100 because of this weird thing called box size. We're not going to get into that today. It's not the important part. The important part is how we can use this information. There's a lot more to point and figure than just price over time. Point and figure shows trends. Positive short-term trends, negative short-term trends, and long-term trends as well. Or to give two different words, short-term direction, long-term trend. Let me show you how we would do that. Direction is very straightforward. We would say that we are going up or positive direction if we are in a column of X's. In point and figure, X's always are going up, O's are going down. So in this case, this chart would be going up, so it would be in a column of X's. The same thing is true on the opposite side, where a column going down would be a column of O's, or our current direction is negative. Then we get trend. To not get too crazy into point and figure, there's this idea of breakouts, which is our current column or our current direction broke above a previous point. Again, if you're interested in that, our relative strength video for our Back to Basics series goes into a lot more detail. All we need to worry about is if our new high is higher than our old high, then we are in a positive trend. In this case, that green line is showing that breakout point. The previous high was right here. Our new high now puts us into a positive trend. The same thing can happen in the opposite direction, where we can have a negative trend, where our current column of O's goes below the previous column of O's. In this case, that would be a double bottom breakdown, which would put us in a negative trend. So what does this all actually give us? What do we get out of this chart? Well, just to review the simple parts again, we get a ratio between two securities. That ratio is not a price. Instead, it is a comparison between what we want to look at compared to something we want to compare it to. We can then plot that ratio over time. We can use a line chart, candlestick. In our case, we're going to use point and figure charts. That point and figure chart, should we choose to use it, gives us two big pieces of information: short-term direction and long-term trend. With those two pieces of information, we now know a lot more about that thing we're looking at, because we now know something that is not just its price. For example, you could look and you could say that discretionary had a pretty bad week. It went down, well, over the course of the week it was about even, but today it went down almost 3%. Okay, that's not great. But we get more information when we compare it to something else. Tesla, for example. Tesla today announced that they're laying off about 10% of their workers. As a result, their stock price took about a 10% hit. So, yes, discretionary lost 3%. Tesla lost 10%. That gives us more context for understanding a relationship between discretionary, this cyclical industry, or the cyclical sector that relies on a thriving economy, will boom in a strong economy, will bust in a poor economy, and compares it to one of the largest companies within discretionary, Tesla. When Tesla's happy, discretionary is happy. When Tesla's not happy, nobody's happy. I mean, discretionary is not happy. So that gives us information. It tells us a little bit more than just discretionary is down 3%. It gives us more context of why discretionary is down 3%. But I'm getting a little ahead of myself. We've now covered the basics of why we use point and figure and why we use relative strength. Let's now get into our 5 methods for how to use point and figure and relative strength. Method number 1 is by far the simplest. Relative strength lets us compare 2 things. Okay, let's compare 2 things. I know, it's straightforward, but it is a method and one that we shouldn't overlook. Just because it's simple doesn't mean that it's not effective. So what this method is just looking when we need to make a decision between this or that. Instead of playing eeny, meeny, miny, moe, catch a stock by the toe, you can just go and do a relative strength chart. That relative strength chart, if we're looking at 2 securities that we don't know which one to buy, is going to give us another piece of information to help us make a decision. Again, the downside here is that it has to be 2. We can't do 3, we can't do 4. Relative strength helps us to make a decision between 2 things. Let's do a quick example to show you what we're talking about here. Again, you do not need to have a Sectors Made Simple subscription to do this, but because it's available to us and because it's a really easy way to narrow down a search for securities, we're going to use it. So if we look really quickly at the current matrix and sort by total strength, we'll see that energy, XLE, is the strongest overall sector. Cool. Now, let's find the leading industry within the leading sector. So if we come over here to our investment resources spreadsheet and we plug in XLE, we see that the refining and marketing industry has been the industry that's seen the most positive change over the past week, going up about 6% in the past week, 9% in the past month, 34% in the past quarter. Cool. So we can click here, and now we get 23 companies. That's still a little bit more than I would like for making an easy decision. So we need to narrow things down a little bit more. Let's just put in some fundamental analysis stuff. EPS growth quarter over quarter. We can add here institutional ownership. We can also add that the price is within 10% of its high for the year. These are fundamental analysis and one technical analysis pieces of information that are tried and true and have performed well over the past 20 years, but not the topic for today. The reason I did this is so that we end up getting 2 choices. We have Valero, VLO, and Valvoline, VVV. All right, now we've narrowed it down to 2 choices, VLO or VVV. Which one should we buy? Let's head on over to stock charts. The link is there if you're interested to follow along at home. Also, if you're watching this recorded, it'll be down in the description. So now let's do a relative strength chart between those 2. Let's do VLO compared to VVV. And what we end up getting is an ad. What we end up getting is this chart. Again, we are comparing VLO to VVV. So if the column is in O's, which it is, that means short-term Valero is weaker than Valvoline. if we want to see long-term, our most recent column above or below the previous is going to be this column of X's right here. That means that the short-term direction is negative. The long-term trend is positive. So short-term, Valero is not doing as well as Valvoline. Long-term, it's doing better. Now the cool thing about relative strength is we can flip them. We can try doing Valvoline versus Valero, where here we see that it is still negative, which means that in this case, Valvoline is short-term weaker than Valero. Wait a second. I thought we just said that it was stronger. Now it's weaker? Yeah. Relative strength is not always going to be the exact opposite of each other. Because of the way that ratios work, it can be that both charts, in this case, Valvoline versus Valero, is in a short-term downtrend, or down direction, to keep things separate. But Valero compared to Valvoline is also in a negative direction. What that tells us is that they're not decided. It is in a weird state that it is neither positive nor negative. We have two different pieces of information that disagree. And that's not a bad thing. What that means is there's no agreement. What there is an agreement in, though, is long-term. If we look long-term, our most recent breakout is this column of O's where you see the 5. So we are in a long-term downtrend for Valvoline. Now we're getting somewhere. Because in the previous chart, let's just really quickly throw this up here. Does this work? It does. When we were looking at Valero compared to Valvoline, it was in a long-term positive trend. Valvoline compared to Valero, negative long-term trend. So the short-term, they're still trying to figure out what they want to do. But long-term is decided. Long-term, we see that Valero is the stronger one for both when we're comparing it to Valero, as well as when we're comparing Valero to Valvoline. So in this case, short-term is not decided. Both charts are in columns of O's. Long-term is decided. The long-term says that Valero is stronger than Valvoline. So if it came down to a decision, this is another piece of information that you could use. Again, this is not the holy Bible of strategies. This is another piece of information that should be used in addition to other methods. Chart breakouts, moving average breakouts, whatever your strategy is. The great thing about this is it can work into your strategy. This is not you need to change the way you invest. It's just when you're trying to make a decision, it gives you another piece of information, another opinion. How often do you go and you try and buy something, and instead of just going out and buying it, you Google best, let's say I want to buy a boat, best boats under 30 feet. Okay, you do your research. All right, well, I know I want to use the boat for fishing. Best fishing boats under 30 feet. Maybe I don't care about the size. Okay, best size for a fishing boat. Okay, well, I don't know how many people are going to be in the boat. If more people, I'm going to need a bigger boat. Less people, smaller boat. So you go around and you ask your friends, hey, do you like fishing? Hey, do you like fishing? If all your friends say no, find new friends. I mean, then you know that you don't need as big of a boat because you're not going to have as many people on it. If every one of your friends say, yeah, we love fishing, let's go out this weekend, you're probably going to need a bigger boat. This is like asking your friends if they like fishing or not. But instead of going out and fishing, we're talking about deciding between two different companies. Both companies are in the leading industry, in the leading sector, and both have very strong technical and fundamentals. So if we need to make a decision, this is another piece of information. It is not perfect. No piece of information is perfect. But the more information we have, the closer to that perfect decision we get. So that is method number 1. It's just using relative strength for relative strength. No end goal, nothing else in mind other than I want a second opinion. So, with that done, let's go on and look at method number 2. This is going to be comparing a security to its benchmark. Whenever we're looking to buy something, what we're buying usually, and by usually I mean always, belongs to an industry, which is what small group is it a part of? And its sector, what bigger group is it a part of? Just like we did for Valvoline, where it is in the refining and marketing industry within the energy sector. We can do that for any company. So whenever we're comparing or considering an investment, it's very important to compare it to its industry and to its sector. The sources, depending on which source you look at, it's going to be a different number, but the consensus of every single piece of research is that over 50% of a stock's performance is due to its sector. So it's pretty important to know if that stock is performing better or worse compared to its sector, or if available, how it's comparing to its industry as well. So this is great because we don't need only 2 choices. You can just have the one choice and still compare it to something. Again, this is not perfect. Nothing ever is perfect, but it's another piece of information. Some of the easy, very low-hanging fruit for benchmarks. The sector ETF, there's going to be a sector ETF for almost every company you look at. The industry ETF, if that is available. And if all else fails, you can compare it to good old S&P 500 or the ETF for it, SPY. Again, the benefit of this method is that it works into whatever you're already doing. My goal is not to tell you that you need to change the way that you invest today. My goal today is to show you more information that's easy to understand and easy to use to help you in how you are already investing. Everyone wants that second opinion, so use numbers, use real data instead of a person's opinion. That's why I always say, trust but verify. The numbers don't lie, but liars use numbers. So let's go back to our example that we were doing before with good old Valvoline, or rather, Valero. Because what we're going to do now is we're going to take that information that we just learned from method number 1, where we saw that Valero was outperforming Valvoline. The first thing we can do is if we go over here to FinViz and we look up VLO. Again, we already know its industry and its sector because of how we got to that final answer. But I'm trying to go where this could be your friend told you about a new stock, GameStop. not the actual example we'll use, but imagine someone comes up to you and says, hey, you should invest in GameStop. This is one way that you can see how well GameStop has been performing. Use relative strength. Because we were doing this example already, let's continue with Valero. If you look up the chart on FinViz and scroll down, you will end up finding its sector, which Valero is in the energy sector, and its industry, which is refining and marketing for its industry. Coming back over to this resources spreadsheet, just to keep our lives easy, the closest industry ETF that we have is not marketing, it's just refining. It's going to be the industry ETF CRAK, C-R-A-K. So now we can go over here to stock charts, and we can do VLO compared to CRAK. And what we end up getting is another relative strength chart. In this case, we're now going to be looking at Valero compared to the oil refiners ETF CRAK. We have those two pieces of information once again. Our short-term direction, which is X's, so positive. That means VLO is in the short term outperforming CRAK. Then we have our long term as well. This X is not above the previous, this O is not below the previous. Going one column back, there we have our signal, which would be a breakout or a positive trend. So now we have short term, VLO is outperforming the industry ETF. Long term, VLO is outperforming the ETF. The next step would be you can do the inverse. You can do CRAK compared to VLO and get that second point of comparison. But we're going to keep things simple and just keep things moving forward. Let's now compare it to energy, the energy sector. Here, we find a little bit different of a story. Again, we are in that short-term positive direction with the current column of X's. But long-term, we see a negative trend. Here we see that the most recent signal that we have is this column of O's below the previous column of O's. So now we know a couple more things. Valero is outperforming its industry, short-term and long-term. Valero is outperforming energy, short-term, but not outperforming it long-term. So 3 of the 4 signals are saying that VLO is stronger than its industry and its sector. 1 is saying that the sector is stronger than Valero. The next steps here would be flip the charts, do XLE versus VLO. But again, the goal here is to show the thought process. Ways that you can get more information. And again, this doesn't need to just be Valero. You could go in and look at GameStop. You have consumer cyclical for its sector, specialty retail for its industry. So you could go and you can compare GameStop to discretionary. And kind of looks a little bit like the Himalayas. A lot of big peaks and troughs. But let's see what we have here. We have a current column of X's. So GameStop is outperforming discretionary short term. And by a very large amount, the most recent signal is right here. We see a positive trend as well. So GameStop is outperforming discretionary, short-term and long-term. But there's one last thing that this chart gives us. Notice, let me go back for a second. Apparently it doesn't want me to go back. Look at the size of each one of these columns. The way the point and figure works is each line is not one day, it's one trend. Positive or negative trend for X's and O's. All of these columns are pretty small. Now, yeah, the smallest ones are 3, the largest ones we're seeing like 7, 8, bunch 8. That's telling us that this relationship, Valero versus energy, it does change. They're not perfect. We'll look at some later that are pretty close to perfect and what those look like. But this is not perfect. But it's also not crazy. There are changes in the trend. That's what we want. We want those differences. Now compare that to another error screen. Compare that to GameStop versus discretionary. We saw before how 3 was the smallest reversal and 8 was the biggest. Here, 7, in this case, 5 is the smallest I can find. But the biggest is a bit different of a story. We'll be here for a minute counting if we want to really see how big these columns can get. So in addition to just showing us the trend, short-term direction and long-term trend, it also tells us how volatile that relationship is. In this case, it's a pretty volatile one. Not because of discretionary. Discretionary is sensitive. It is the sensitive sector. But GameStop is even more so. And this chart illustrates that perfectly. So relative strength not only shows that trend, short-term direction and long-term trend, and the relationship between the two securities, but also the volatility between those securities. The only problem, and again, my job here is not to tell you why relative strength is perfect, it's to tell you what it can do, but also what it can't do. It doesn't tell you which one of these securities is the volatile one. All it tells us is that the relationship is volatile. So in this case, I can tell you with certainty, but only because I know the stock, that GameStop is the one that's the volatile one. Discretionary still is sensitive. After all, it's seen +3 and -3% days in the past week. And a lot of that is because of Tesla. But GameStop is up there as well. So that is method number 2. Comparing a stock against its index, its industry, or its sector. Or do both. So that covers method number 2. Let's now look at method number 3, which is going to be using relative strength as market atmosphere. Market atmosphere is a way of saying, what's the weather going to be like today? It's a simple analogy, but it's an accurate one. What you do and how interested you are to go and do things is based on market atmosphere. If what you want to do is you want to go for a nice drive and go down to the beach, you're not going to do that if it's raining, or even if it's super cloudy with dark clouds. Instead, you might choose to do something a little closer to home. If it's beautiful, sunny, and 80 degrees, okay, that trip to the beach is looking pretty good. So we can use relative strength as a market indicator. And with the current state of the stock market, this webinar, by the way, for context, was recorded on June 3rd of 2022. This market atmosphere is very useful to us right now. For the past month, the S&P 500 has been bouncing between 15% down and 20% down from its high at the beginning of the year. What that means is if 20% is the line for a bear market, or anything below that line now says we're in a bear market, investors don't really like bear markets. They don't like it when it looks like it's about to start raining. So, we're not there yet. We're 15 to 20%, not 20% or more. So what does that mean? Does that mean that we're in a bear market? The answer depends on who you ask. If you ask Elon Musk, we're in a bear market, the market needs to correct, things are too crazy right now. Okay, that's one person's opinion. If you ask the numbers say 20% or below is a bear market. So the math says, no, we're not in a bear market. If you go and you ask a group of investors, by investors I mean quite literally investors.com, they track market sentiment and bullish and bear sentiment in the market, so how people are feeling. The majority of investors would say that they think the market's bearish. Okay, that's their opinion. Let's, again, get out of it asking our friends, or a group of friends, and instead, let's look at what I like to call tug of war between the index ETFs and their inverse alternatives. That's a lot of big, crazy words, but let's explain it like this. An index ETF follows the performance of an index. When that index goes up, that ETF goes up. But there's also what are called inverse ETFs. These inverse ETFs follow an index, but when the index goes up, that inverse ETF goes down, which means when the index goes down, the inverse ETF goes up. It is inversely proportional, or its relationship is inverse. So when one goes up, the other goes down. When one goes down, the other goes up. That's valuable to us. One, it's an interesting way to invest in a bear market because you are trying to profit off the stock market going down without having to start shorting things and all that kind of stuff. It's simple. You buy an inverse ETF, and when the market goes down, you make profit. But in addition to it being an investment, it also lets us compare the market against the inverse of the market. To keep things pretty simple and to keep things, again, just as the introduction to this all, here are some comparisons that we can use for some major indices. The S&P 500, we have SPY, which is the bullish S&P 500 ETF. So when the S&P goes up, SPY goes up. And SPDN, which is the inverse ETF for SPY. So when the S&P 500 goes down, SPDN goes up. That exact same thing, comparing the one that goes up with the market against the one that goes up when the market goes down, is the next couple of comparisons as well. So for the Nasdaq, we have QQQ, and for its inverse, we have PSQ. For the Russell 2000, which looks at small cap companies, we have ZPRR compared to RWM. If the US isn't your thing and you're interested in emerging markets, then EEM is going to be your bullish, while EUM is going to be your bearish ETFs. And if the big guys or the small guys isn't your kind of thing, and you want to go for those middle or mid-cap companies. The S&P 400 mid-cap, we have IJH. So let's go really quickly and take a look at one of these charts so we can see what we're talking about in action. So here we're going to have, let's do SPY. So again, SPY is going to be the bullish ETF. So it goes up when the market goes up. SPDN is going to be bearish. So it goes up when the S&P goes down. And here's what it looks like. Again, 2600 is not a price. It is a relationship, a ratio between the price of SPY and the price of SPDN. What's important is not the price, it's the direction. What we see is right now, we're in a column of X's. And right now, our most recent signal was a breakout, positive. So what this is saying is right now, the bulls, short term, are beating the bears. The bulls, long term, are beating the bears. But that changes. And to show you the change, let's go back in time to 520. This was the day that the market hit bottom. So far, the bottom. Hopefully, the bottom. Here we see a massive column of O's, which means that SPY short term is underperforming its inverse, and long term is underperforming its inverse. So that was 2 weeks ago. We see that SPY is getting beat by the bears. The bears are beating the bulls. We now can go 1 week further. So this was last Friday, May 27th, where we see column of X's. So short term, the bulls are beating the bears. Long term, the bulls are beating the bears. Now, how can you use this information? Well, you can use this information if you're trying to decide how do you position your investments. Should you get aggressive? Are you going to get super aggressive? Are you going to make these big plans if the weather outside is super cloudy, very dark clouds? You can hear thunder somewhere in the background. Are you really going to plan out a barbecue with all of your friends on the beach? No. You might still go down to the beach because the weather is nice enough, but you're not making big plans. You're not betting that the weather is going to get better. You might play things safe. If the trend has been positive, is positive, and might always be positive, never the case, you're going to be a little bit more interested in making those big plans. So that's how we can use market atmosphere. Use it like checking the weather. If we see that strong positive trend for both short term and long term, you can make a little bit bigger of plans. If you see negative, or if things are changing a lot like they are right now, maybe those long-term big plans for that barbecue, not the best idea. And there's so much room in between. So the best way to understand these charts is to follow them over time and get to see how these events change. Because next Friday, I can nearly bet there's going to be another thing for us to talk about on this chart. Let's now look at method number 4. We can think of index ETFs as being a representative of their index. After all, an index ETF, the one job they have, literally one job, follow its index. So they should be perfect, right? They're not. Nothing in life ever is perfect, sadly. In reality, ETFs are pretty close. And many of them are almost dead on with how close they are to tracking their underlying index. But it's not perfect. And we can see how perfect they are by using relative strength. Stock charts provides us some awesome resources for comparing ETFs to their indexes. Or, if we can't find a perfect one, similar indexes, to see how well that ETF follows its index. Now, note, just like with most relative strength, we don't care as much about the actual value of the chart. Instead, what we care more about is the direction and how much that chart goes up and down. So we can do this for a number of different ETFs and indexes. We can do the S&P 500 ETF SPY against the S&P 500 index. We can do ETFs versus their indexes. We can do some industry ETFs versus their industries. And we can also do other major indexes versus their underlying indexes. Major index ETFs versus their indexes. I'm going to show you one example, and then I'm going to show you how you can find all the examples. So if you come over here, we can do SPY and compare it to dollar sign. Dollar sign is telling stock charts that we want an index. There are tons of them. SPX is the S&P 500 index. So this is what that chart looks like. Notice how closely these charts, or how close the relationship is. 97, I guess 96 is the floor. 102 to 103.99 is the ceiling. And it bounces pretty consistently between those, or at least it has for 2022. What that's telling us is that SPY is pretty darn good at tracking the changes in the S&P 500. It is not perfect. No index ETF is ever perfect. But it's pretty darn close. Why don't we see the lines red or blue? So those lines, the red and blue lines, are showing us trends. It's only going to ever show us one trend at a time. And because right now, the strongest trends are negative trends, that's the trends that it's showing us in these charts. I can do a whole webinar one of these days on trend lines on stock charts. It's actually really interesting. So this lets us see SPY compared to $ SPX. We can also do VOO, where we see a very similar thing, but a little bit more change. We have more columns of 4s and 5s than we did for this chart, where it's mostly 3s and 4s. The bigger the column, the bigger the difference is between that ETF and its index. If you're ever curious to find an index, my recommendation, search index and then whatever you're interested in. So, semiconductors. $, we always want the $, that's telling us it's an index. So we could do SOX compared to $SOX. And once again, here we get their relative strength. The smaller the column, the more closely that ETF follows its underlying index. So we notice here, it follows it pretty closely, except for in May of 2020, where it tanked. No ETF is perfect. But this helps us to understand how perfect they are when it comes to following the thing that they're supposed to track. Again, index ETFs have one job: follow their index. And now, the last part of all of this, we get to come and talk about sectors made simple. Because a lot of what we've talked about today, we can only do a comparison between two things: what we want to look at and what we want to compare it to. If you have a Sectors Made Simple subscription, or if you purchase a Sectors Made Simple subscription, you'll get access to our custom matrix, which lets you create a matrix of relative strength charts for anything. We can, for example, use methods 1 and 2 that we talked about today and put them together in one relative strength table. We can compare two companies, but also compare those companies to their industries and to their sectors. There is a limit to how many things we can put into a custom matrix, being 7. But there's no limit to how many custom matrices you can make. Additionally, every custom matrix you run is saved, so you can rerun it in the future, or you can update it to see where it's at today. Is the long-term positive trend compared as well? So for comparing the ETF to its index, not really. We care less about the current direction, and we care more about how much it changes. We want it to be as close as possible. The perfect chart is one that there is no chart. That means that it follows perfectly. But again, nothing ever follows perfectly. So the smaller the column, that means that the changes compared to its index are smaller. So the smaller the column, the better. We don't have too much time today, but I really quickly want to show you all a custom matrix that I ran, which was taking those two companies we talked about before, Valvoline and Valero, and compares them to the S&P 500, SPY, to XLE, the energy sector, and to their overarching industry, refining. So what we find here is if we sort by short-term X count, that VLO is the current leader with 3 positive counts. If we look at long-term trend, we see that Valvoline holds the highest, tied with energy for the highest long-term strength. But if we sort by overall, we see that Valvoline has the highest overall strength compared to another company that had strong fundamentals and technicals, its industry ETF, the sector ETF, and the S&P 500. And again, we go into more detail about why this matters and how you can use it, but if we see how this chart has changed over time, compared to 1 week ago, everything has lost strength, but compared to yesterday, Valero gained +2 in short-term strength. So what we're seeing is this number went from 1 to 3 and is gaining that short-term strength quickly. That is the value of tracking these custom matrices over time, finding a group of companies, sectors, and more that are interesting to you, and getting to update those charts daily to see how they change. An ongoing series that we do is we do custom matrices for many different groups of companies and their benchmarks, and we update those matrices once a month to see what's changed. So that custom matrix check-in, as we call it, we do once a month, and is very interesting and is a great way to track real-life changes in the market, all through relative strength. So if you're interested to learn more about how relative strength can be used to make investing simpler, consider checking out some of our other webinars on relative strength, or start using custom matrices and learning the true value of relative strength yourself by considering to purchase a Sectors Made Simple subscription on our website, sectorsmadesimple.com. As always, we are here to help if you have any questions, comments, or webinar ideas that you'd want to hear us cover in the future. And thank you all so much for joining us today. I hope to see you all back for another webinar next Friday as we continue to make investing and using relative strength simpler. Thank you all so much. Have a great weekend.